Hi everyone. So in the previous session, we have completed the bare basics to the area called as derivative options. How the options market works, reality behind the holders, reality behind the writers, what is the relation between a holder and a writer, how a insurance contract, similar contract is created, what is the meaning of a premium, what do we mean by a call option, what do we mean by a put option, what a call holder will do, what a call writer will do, what they do with option, what they do with the share. All these things we have understood, and we have also done three different questions in that area, which will give us a real intention behind the concept called as derivative options. So in this lecture, we are going to make some advancement to the learning process in the chapter called as derivatives. What we learned in the previous session, in a nutshell, if I have to tell, derivative is a instrument in writing which derives its value from the value of its underlying asset, generally a share, sometimes commodity as well. So it derives its value from the value of the underlying asset called as a share. So share is an underlying asset on which the derivatives will be written. Derivative is an instrument in writing which derives its value from the value of its underlying asset. Next one. Derivative has no value on its own. Okay, whenever the market price changes to the share or a commodity, automatically the underlying asset also will tend to change. So therefore this is called as a derivative. Means what? Because of one, this is getting changed. That's why we call it as a derivative. dy by dx type. So there we also understood that there will be a person called as a call holder and also a call writer. Put holder and a put writer. Writers are always insurers, holders are always insured against the risk. There we also understood that option holder will have an option to buy. How he get that option to buy? Because he will buy an option first. So call holder will buy an option and also buy a share optionally, or not an obligation. Put holder will buy an option and sell a share. Call writer will sell an option and he will sell a share. Put writer will sell an option and buy a share. I already said this in the form of a charting as well. Clearly explained whose position is what. So with that we completed that part of introduction as well. Next, after that, we came into understanding of when he will exercise, when we will lapse. Call option holder will always buy a share with an intention to buy, he will enter. Always we should have a buying price lower. Therefore the idea behind the concept is buying price should be lower. What price is in my hands? SP. It should be always lower than AP in order to exercise the option. And the put holder is the reverse case. He will sell the option, he will sell the share. Therefore he will always assume that SP should be greater than AP to exercise the option. So this is what we have understood in the previous session with regard to the put holder. Always holders will buy options, always writers will sell option. There are two assets here. Option is one asset, share is another asset. So we first buy an option and then we will buy a share. So at the nutshell, this particular when to exercise, when to lapse, we understood SP less than AP, call holder will exercise. SP greater than AP, put holder will exercise. SP greater than AP, call holder will lapse. SP less than AP, put holder will lapse. Whenever you lapse, the other party called as writer is safe. He will get the premium amount, but he need not deliver any kind of share. It's like an insurance policy on a vehicle we take. We will pay 1000 or 1500. Vehicle not met with any kind of risk or accident. Then entire 1500 is his profit. Same way it will also work even in the derivative segment. So hope everyone understood the logic behind this. With this we have done also three problems which will give us a clear impression as to who will do what. Now in this lecture what we are going to do. So when we will exercise, when we will lapse, understood. Okay, when we will get profit, when we will get loss, also understood. Now in this session, we are going to see some complicated advancements to the options concept called as a net payoff and break even. Why I am telling complicated is two types, sir. First point number one can understand this concept in two ways. Way number one, mug up the concept like anytime we do. Understanding the real intention of net payoff and doing now, definitely it looks something complicated. That's what an analyst require. Okay, we don't want to just read and write exams now. We want to analyze the stocks. So if really your intention is to analyze the stock, not just a bookish intention, then definitely the next 1.5 hour will be yours. Definitely it will be capturing your attention. So how this particular concept of options work in real life scenario. Real life scenario, I want to know how it actually works. Then definitely this lecture will change your idea behind the options. How to understand the options market. Sir, I am investing in options. What to do? Because generally we people mean don't include me. I have both hedging strategies. I have both speculation activities. Okay. But once these SFM classes are entirely completed, then a separate area I am opening in the YouTube where I will be analyzing all the stocks live. I will show the portfolio, how to manage options market, how the premiums are collected, and when to sell, when not to sell, when to exercise, when not to exercise, how speculative transactions like short sell can happen. All these things we are going to analyze in a different lecture, not this. Okay, but here I will tell you the entire science behind this. Okay, I am not talking about SIGNS. SCIE and CE, science. So entire science behind this options market, how stock market really behave with regard to these options, we are going to understand using our exam questions. Okay, how beautifully they draft the questions, how to understand and what to understand. Let us try to make a clear path analysis on this. Okay, so we are going to start with question number 4. Take question number 4, everyone. Just a minute. Okay. See here, you have bought a 6-month put option. You have bought a 6-month put option. It's not bought 6-month put option. Okay, bought a put option means you are buying a put option. That means you are a put holder. This is the intention. That's how you need to understand. That's why on the day chart, put holder, what he do with option, what he do with share. Okay, if the question says you sold a put option, you are a put writer. Share, what you do depends on the expiry date. Okay, on a share with an exercise price of 96, premium of 4. The share has current price of 100. You are expecting two things to happen. Share may either come to 108, share may either come to 95 after 6 months. What will be your payoff when the option mature is the question now. Okay, so we are opening a share with a put option at 96 rupees at a premium of rupees 4. The share has a current price of 100. Current price is irrelevant for us, but in the future exercise price is trading at 96. You expect share price or share to raise to 108 or 95 after 6 months. Means 96 la you are trying to buy, you are trying to sell na, you are expecting either it may go to 108, either it may come to 95. Anything can happen. What will be your payoff when the option matures is the question now. Okay, what will be your payoff when the option matures? Question number 4. See here, calculation of payoff. If the share price, my lock-in price is 96. If the share price comes to 108 and my strike price is 96, okay, my strike price is how much, sir? 96. As a call option holder, I will exercise. Okay, I have done this question on the basis of a call holder. Okay, you can do it also as a put holder as well. Okay, so I have done for whom? Call holder. Why? Question asked for put holder, sir. Why you have done for call holder? For understanding sake. Okay, they asked for put holder only. I have done it from the call holder point of view just to make you understand. Okay, now I will do for put holder as well, live. Okay, so see here now. First, let us see for call holder. If the same happens for a call, 96, actual price is 108. I can buy a share, call holder, as a call holder, let us see. I can buy a share at rupees 96, which is available in the market at 108. I will exercise a lapsa, exercise as a call holder. Okay, so now what is your value? My value will be 12. My value will be how much, sir? 12. Means 108 is the actual price, 96 is the strike price. Value will be 12. Means I am purchasing a share which is worth 108 only at 96. What does it mean? How to understand? The value is 12. We will write value 12. But what is the real value of this 12? I will explain. You are a speculator. You are whom, sir? Speculator. What a speculator will do? Speculator speculates a price, anticipates a price, forecast a price. He want to make an obvious gain or a loss. That's all. He is ready for both. Okay, you are called as a speculator. Now listen carefully. How to understand with the numbers? That's why I have taken call as an example. Now I will erase this and write the answer for put. But you should understand how call will actually react to this. See here. There is a share. Current market price is trading at 100. Current market price is trading at what, sir? 100. Okay. Now I want to make gain out of this share. Not today, because I don't have share today. I want to make in the future. I want to make in what's a future. Okay. Now listen carefully to the logic of the question. See here. Okay. So see here. I will explain a transaction. Today, I am standing and seeing a share. The share is trading in the market at 100. I saw the strike price. Share strike price is trading at 96. First question number 1 you may get, sir. If the present price is 100, why strike price is trading at 96, sir? Is there any reason? Will it be trading like that really? Yes, obviously. When it will be done like that, that's all. That important concept we are going to understand in the advanced problem. Problem number 21 onwards, sir. Arbitrages with the dividends. There we will see the advanced complicated issues in the derivative options, sir. The deadly questions that can come in examination, twice or thrice also asked in examination to screw the minds of the students. So that problem also we will do. At that time I will explain really why strike prices will be lesser than the actual price at the current market. Am I clear or not? So what factors will influence the strike price to come down? That also I will explain when we come to the appropriate stage. But as of now, reality let us understand. Today I am standing in the stock market. Open the website. Regarding the Zero, the Upstocks, whatever the case may be you are using. I am opening the app. I am opening 3 blocks. Number 1, options, equity segment. Number 2, F&O segment I opened. Equity segment of TCS I clicked. Okay. It is around 3000, 2958 or somewhere it closed yesterday. 3000 let us take. Okay. I am not taking 3000. Example 100 I will take. TCS share equity segment like open, cash segment means what? Immediate buy, immediate sell, no future. 100 rupees it is getting traded. 100 rupees it is getting what, sir? Traded. Immediately next tab I open F&O segment to the same TCS. It is trading at 96. Now what you have to do? As an investor, what call you have to take? First sit calm, relax and then take a decision properly. What is your estimate? Read the news regarding TCS. Go back. If possible through newspapers, if not possible through the apps like Money Control. Open the newspaper or take the news on hand. See about TCS. Is there any future project? Is there anything happening to TCS? First observe that. You found that there is a project which will be opened in the next 3 months. Our quarterly results are to come in next 3-4 months. Or there is a project which will be completed. Our software market is expected to have a rise in the market. You are expecting many things to happen. Now you expect personally that, okay, you expect personally that price will move and go beyond a particular level of 96. So as an investor, what decision we have to take? You have three things in mind. Number one, stock presently is getting traded at 100. Strike price is traded at 96. Immediately the mindset should be in such a way that a share which is worth 100 today, as per time value of money concept, it should raise in the future, but it is not raising. Okay, it has a fall in the market. Future la I can buy only at 96. Okay, don't jump and unnecessarily buy them. First understand, today the future is expected to be 96, but really on the day what could happen, that you need to extrapolate now. For that you require news. Available news we have to read about the company. On that you should have one perception. Everyone will have their own perception in mind. Someone will perceive that it will increase, someone will perceive that it will decrease. You should have your own perception. On that basis only you will take a position. You understood that price will be definitely more than 96 in the future. That means definitely it will go somewhere around 105 or 106 or 107 somewhere. In this problem it is 108. Am I clear? I am expecting share price really to trade at 108 on the expiry date. Okay. Now, three numbers I said. Today's price 100, future locked price 96. My expected future price will be there. Somewhere 105 or 106 or 107 or something will be there. Clear, everyone? Three things I have. So then what is 108? 108 is the real actual price. That's the fourth price. Cash price today. Strike price today. Quoted future price. Expected actual price. I will expect something to happen in future. That's why only I will enter into option. Fourth one, actually what is getting traded. These four prices will confuse every option holder. On that we need to have a pakka clarity. So in this question, the cash price is 100. Strike is trading at 96. What is your expectation as an investor? I expect a share price definitely somewhere 102 or 103 it will be. It will not be at 96. Maybe sudden fall may be there today, but in reality it should not be 96. It will be decently trading at least 102 or 103 somewhere it will be. So you are expecting a price higher than 96. Higher than 96 you are expecting. Immediately what you will do? You will jump into the market, enter into a call option. Why you enter into call option? Example I will tell you. Call option holder will buy a share, sell a share. First answer this. Call option holder will buy a share, sell a share. Everyone, whoever is listening to the class, call option holder will buy a share, sell a share. Call option holder will buy a share, sell a share. The question will arise or not? Obviously he will buy a share. Obviously he will what, sir? Buy a share. Now listen carefully to the point. I expect that the price of the share will rise in the future. Okay, it will not be 96. Somewhere above 96 only it will get traded. 98 or 100 or 105 or 106. So somewhere it will be traded. Okay, what is the benefit to you? I can exercise and I can buy the share at a least price itself at the today's quoted price of 96. Why you are doing all these things here? I am doing for one reason. Because today what is the price of a share? 100. That's why in all the questions given in the institute material, if you observe clearly, though there is no use with that information, they will give the current price of the share. Really, there is no importance to the question. So generally what people say, hey, that is irrelevant. If that is irrelevant, we have the biggest fool on this entire planet Earth. Sir, here, doing the problem is not the point here. You will do the answer, you will get the answer as well. But whether we are learning it or we are just like a fool, we are just putting numbers and writing the tables is a question here. Don't feel otherwise, I am really making it sense. So, there should be some sense in doing the questions. Na? I got the answer, this bacha question will be answered by anyone. It's not that. It's about how you understand this particular question. Current share price 100. Future trading at 96. Means what is the intention? Short sell at 100 today. What you have to do? Short sell at 100. So today price is 100. Future I can lock myself as 96 means what you have to do? First short sell the shares at 100 today. Do it. Short sell the share at 100 today. Short sell. What will happen? 1000 shares I sold at 100 rupees. 1 second, where is the calculator? See here. 100 rupee per share into, okay, 100 rupee per share into what we have to do? For example, I sold 1000 short sell shares. 1 lakh rupee obtained or not? Okay. Today itself, I opened the market and I also clicked on 96. I also clicked on 96. 96 strike price I clicked. Okay, I clicked on strike price of 96. Means what? I am surely, whether I will buy or not, God should know. But I will buy the share for sure because I short sold the shares already. A person has borrowed me the share, lent me the shares, I borrowed the shares. I have to give him back or not? To give him back, what I have to do? I have to buy in the future and I have to give back. So buying in future is inevitable. I can't escape from the progress of buying. From the activity of buying, I can't escape. Whether I will buy with the writer or whether I will buy in the market is entirely different scenario. But buying is guaranteed because I already short sold the shares today. So current market price is 100. I watch the market. Current price is 100. Futurely it is 96 page. Obviously, what you will do? You will sell the share now. You will short sell the share. You got 1 lakh, and it is a damn sure that you will buy either at 96 or less than 96. That's the beauty of options market. Means what? Really, market price on the day you expect more than 96. What will happen here? You will exercise and buy it 96 and give him back. At that time, your outflow will be 96,000 only. So 4,000 gain today only. I know. What is your maximum gain? For example, if the actual price is not 108, 105, 106, it is 94. What you will do? You will buy in the market and give back 94 into 1000 shares. It is 94,000 and the gain is more increasing now. Means what you have to understand, in always in an options market, okay, call holder will short sell the share today and we will buy in the future and he will repay back. This is called as a speculative transaction. This is called a what transaction, sir? Speculative transaction. Speculative transaction means what? I will buy, I will sell. That's all. I will make a gain, I will make a loss. Okay. In this progress of speculation, a hedging element also included. That hedge element is option. Why? It is covering your risk. Hedge means what? In Forex chapter also I explained. Hedging is a method of making profit, covering the risk. Covering the risk. Risk reduction strategy is hedging. So options market is a risk reduction strategies. Am I clear? It will neutralize your risk. That's why one of the model is also there in options valuation called as a risk neutral model. That's all. It's a hedging strategy. Hope everyone understood the point. Share market you are doing speculation. Okay, you are speculating on share market. Options market will act as a hedging for that speculation. Okay, your speculative market will be protected by a shield called as an option. Now what will happen on the expiry date? Two things can happen. Actual price turned to be 108. Now what you will do? You will lapse it, you will exercise it and buy at 96 and give back. If you buy at 96, what will happen automatically? If you buy at 96, what will happen automatically? 96 rupees you will buy and you will repay back to the person. Am I clear? You will give back the share to the other party, which you have sold at 100 rupees already 6 months back or 7 months back or 3 months back or you sold. Like that you can understand. Or you are just buying it. Yes or no? You are buying it. As a speculative transaction, if you want to see, I will buy a share at how much? 96. Immediately also I can sell the share at 108 to some other party. That's why the value of a call is just a minute. Okay, it's working. Very sorry, pen doesn't work. Okay, see here. Sir, first problem may take time. Patiently listen to the concept. Concept you crack na. Later questions you will have a clarity. Okay. So you can understand options market in two ways. from a hedger point of view, from a speculator point of view. Whatever I explained now is a hedger point of view of understanding. Hedger point of view means what? Already you short sold a share today at 100. If you short sell a share, what is the intention behind? You short sold at a higher price today. In the future, anyway you have to buy. Whether you will buy in the market, whether you will buy with the writer is a question now. When you will buy with the writer, you will buy if the actual price is more than strike price, or strike price is less than actual price. You will buy at 96 and give him back. Say for example, in the market it is available only at 95 or 92 or 93. Then you will buy in the market and give back. Anyway, your outflow don't cross beyond 96. Means I don't give a guarantee that you will make abnormal gain, but I can tell that you will never experience a great loss. Okay, this is one way. I want to see this purely from a speculator angle. I want to see this purely from a speculator angle. Problem is done on speculator angle only. How it has to be understood? Let us see. Tell me, what is the strike price traded on the question? Strike price is 96. How much is the actual price? 108. I am a call holder. I am what holder, sir? Call holder. I am not short selling any share today. I am not short selling any share today. That means I don't have any existing position. I didn't take any existing position as of today. I am not doing any transaction today. Okay. I just opened only options market. I opened only what market, sir? Options market I opened. Okay. Listen carefully. Listen very carefully. I opened options market only. I didn't touch equity segment. I didn't touch cash segment. I opened only F&O segment. I am watching it. I saw strike price as 96. I am expecting on that company. Strike price 96. Definitely this share may rise in future. At that time, I can sell at a higher price. Like that I can imagine. What I have done, I went into the F&O segment. On TCS share, I locked myself at 96. Real TCS price is not 96, 3000 it is. Example. Okay. Let's not unnecessarily complicate by putting great numbers. Let us understand the simple numbers. Share of a TCS is traded in the options market at 96. Okay. Actual price is 108. This is a price prevailing after 6 months. Okay. What I expected is 105 or 104 or 103, somewhere it will be. Definitely. It will be definitely 5-6 numbers higher than 96 here. That is my intention. Okay. Now what I will do, as an option holder, I will not buy at 96. I will not buy at 108. Today, I will pay premium of 4 rupees. Today I will pay what? Premium of 4 rupees. Today I will pay a premium of 4 rupees. And I will enter into the options market. Today I will enter into what market, sir? Options market by paying a 4 rupees premium. Let us see what will happen. I waited for 3 months. I slept happily. After 3 months, price really came to 108. Price really came to what, sir? 108. Now what I will do? Obviously, I will exercise the option and buy at 96. In the market, how much is the price traded? 108. I will immediately sell for 108. Now, how much gain I made? Just by making this transaction, 96 I bought, 108 I sold. That's called as a value. This is how you should understand. That means all the options problem we do in the table are from the speculator point of view. Or from which point of view, sir? Speculator point of view, not from hedger point of view. Hedging means what? Already you have taken one position. On that position you are taking a call or a put, as the case may be. Previous example, I short sold at 100. To close that short position, I have to buy. For that I am entering. At that time your gain will not be 12 rupees. Am I clear or not? At that time, to close the short position, you bought the share. Say for example, today I short sold at 100. Today I short sold at how much, sir? 100. I entered into the option market. Really price turned out to be 108. What I will do? I will purchase at 96. What is my real gain? My real gain is 4. Okay. My real gain is how much, sir? 4. So how it will become 12? So therefore, question has to be understood properly. If a crack fellow like me has to give a question, I will add one line. Solve the problem from the basis of a hedger. I will add one line. Not as a speculator. If Mr. A is a hedger who short sold the share, how the option position will be? Question mark. Another point I will add. So these are all done from speculator angle. Speculator is a gambler. Okay, speculator is a gambler. So if you observe clearly, say for example, one lot size is 1000 shares. One lot size is almost 1000 shares. Today, I will pay 4 into 1000, 4000 rupees I will pay. Yes or no? Yes. Today I will pay 4000 rupees. It's an outflow for me. Okay, I will write it in negative. In future, what I will do? In future, I will buy at 96,000 rupees. Okay. Market price is how much? 108. Immediately, I will sell at 1,08,000. Okay. So now what will happen? 1,08,000 minus 96,000 minus 4,000. I am making an obvious gain of 8,000. 8,000 by making any investment, just by last day, just I will buy and I will sell. On that, I am making an obvious gain of how much? 8,000 rupees for every 1 lakh. For every 1 lakh. Mean how much is your return percentage? 8% is your return. How much percent? 8%. Now you will see 8% return. If I put in mutual funds, I will be getting 12-13%. Then escape this and go there. Okay. So this is how we need to make our investments more stable. More about this we can understand with the progressive problems on this particular area. This problem has been done from the call holder point of view, though the question was asked from put holder point of view. Okay. Now I will do from put point of view how it has to be understood. Okay. In reality, question was asked on put holder point of view. To make you understand in the first question, I made an attempt to explain using call. Now, you will tell me the answer now, or you yourself has to understand. Tell me. As a put holder, observe the question and analyze the transaction. I don't want any one of you just to mug up the concept. Take this number, value, premium, don't do. Let's understand the problem from both the perspective. Both the perspective means what? Both the perspective means from the speculator point of view, from the hedger point of view. Okay. First, speculator point of view, let us analyze the transaction. Tell me, as a put holder, I will sell, I will buy. I will sell, I will buy. Speculator is whom? He may make a gain, he may make a loss. He will just on a dare basis, he will enter. Okay. So now, let us jump into the market. I am a put holder. I saw the market. Strike price is traded at 96. Strike price is traded at 96. Okay. Always put holder will buy a share, sell a share. Put holder will buy a share, sell a share. Question will arise or not? He has to sell a share. He has to sell a share. Okay. Now listen carefully. I assume that in the market, the price will be definitely lesser than the strike price. That can be 93 or 92 or 90 or some number will come. I estimate like that. I jumped into the market. Okay. Now as a speculator, what I will do? I will sell a share. But today I will really sell a share. Premium is how much? 4. ₹4 premium. Premium is always a negative number for the holders because we have to pay the premium. We are not receiving the premium. We will pay the premium. So first point, strike price is 96. Actual price is 108. Now, how to understand this scenario? I went into the market. I locked myself at 96. Okay. So I will enter into the market. I saw strike price of 96. That's a sale price for me. Okay, that is a sale price for me. I expect market to be lesser than 96 and I will enter into put option. Okay, I enter into the put option. Okay. Now listen carefully how to react to this. I entered into the market. As a speculator, I am explaining. I clicked on premium of 4. I paid 4 rupees premium. What I thought is actual price will be somewhere 92, 90, 85. Like that it will trade. Okay. Like that I am assuming. Okay. And I entered into the put option market. Put option market I entered. 3 months completed. On that date, real price is trading at 108. Means what? Means what? I can exercise, I have to lapse. I have to lapse because strike price is 96. A share I can sell at 108. Why I have to sell at 96? That means to sell at 96, first I have to buy or not. That means I have to sell at 96 to some party, means first I have to buy at 108 on that day. So on that day, it is 108 rupees. I will buy at 108 and sell at 96 like a fool. So therefore, as a put holder, my action will be lapse. Once I lapse, okay, once I lapse, as a put holder from the option, I am getting any value? 0. But how much premium I have paid already? 4. So I am ended up with a loss of 4. This is a problem with a speculator. Speculator is ready for gains and losses. Okay. Second, I estimated price to be somewhere around 85 or 82, 83 like that. But price is lesser, but not like what I expected. It is only at 95. It is only at 95. So now what will happen? Because it is lesser than what I expect, I will exercise. I will buy at 95 and sell for 96. I will buy at how much? 95 and sell at 96. So obviously I will make a gain or loss. Gain. How much? 1 rupee. So I will make a gain of 1 rupee. How much loss you have made already? 4 rupee loss I have made. So net loss for you is -3. From this, what you have to understand, just because of the reason that you exercise, you may not always experience a gain. You may also get a net loss. Net payoff. Payoff means what? Net profit in the option transaction. That may end up with a profit, that may end up with a loss. So always don't be under wrong impression that if I exercise, I will definitely get a profit. No, you may get a positive value, but overall profit may not be there. Okay, because you have an element called as a premium. On this only the next area will going to start, called as a break-even point in options, which will blow your mind. So how thinking has to change in options, we will see there. Okay, but I hope everyone understood to here. I will rewrite again. I entered into the put option market, clicking on a sale price of 96 strike price. On that day, the trade is happening at 95 on the share. Means I can buy at 95 and sell to a person at 96. So I will exercise. Once you exercise, value will be there +1. But I have already paid a premium -4. So what is my net? -3. You may get a doubt now, sir. Anyway, he know that he is getting a loss, na sir. Then why he have to exercise, sir? He can lapse. If he lapse, please don't ask that question. If you lapse, na 4 rupee loss here. If you exercise 3 rupees loss, at least 1 rupees you can save, na. So you have to exercise. So loss may come, but not bumper loss like 4. 4 on 4 loss may not be there. 3 on 4 loss may come. Okay. So actual price come down to 94, 2 rupee. Actual price come to 93, 1 rupee. Like that it will reduce slowly. Okay. But you have to exercise, because if you don't exercise, entire 4 will loss. If 1 lakh shares, na 4 lakh loss. If you exercise 3 lakh loss, 1 lakh also you can save, na. So that's why you must exercise. That's why you will exercise when there is a SP greater than AP in case of a put option. This is all analysis from a speculator point of view. If the same question, if I ask from a hedger point of view, how to answer? See here. What is the today's price? What is the today's price? The today's price is 100. Today's price is how much, sir? 100. Okay. So today's price is 100. So as a put holder, I have to sell in future. Okay. Speculator means how he reacts, like in the problem. He don't have any cash market transaction happened. He only speculate everything. Okay. He only wants to speculate everything. Means what speculation he will do? Just he will do a speculation work like this. I will pay premium, okay, by paying a 4 rupee premium. Now I will make a gain in buying and selling on the last date. If the market is favorable to him, if it is the first case, what will happen? He has to buy at 108 and sell at 96. Okay, huge loss for him. Therefore, he will lapse it. In the second transaction, he will exercise and he will have a 1 rupee gain on each one, but the premium has eroded his gain and it has become a net loss of 3. This is how the positions of a put holder will generally change in the market. This is a speculative way, but hedge way is different. How the hedge way will be? Let me explain. I saw the market today. How much is the market? 100 rupees. How much is the market, sir? 100 rupees. Okay, now 100 rupees is the market price. Okay, 100 rupees is the market price. I bought the share. I what, sir? Bought the share. So I bought the share and I entered into the cash market. Now from the day I bought the share, no sleep. 10,000 shares I bought at 100 rupee each. So it's 10,000 into 100. How much I invested? 10 lakh hard-earned money. Hard-earned money of 10 lakhs. I put in the share. Directly I purchased the share. Now every day sleepless. Now what I will do? Since I don't have a sleepless night, I want to do something to hedge this particular situation. Immediately I went into the market. Which market? F&O market I entered. And I watched the particular share, how much it is trading. Okay. To my surprise, strike price is trading at 96. Strike price is trading at what, sir? 96. Means what? If I have to sell this in the future, I bought to sell. Okay, if I have to sell this in the market, at what price I can sell? 96A I can sell. Now fear started in me. Array, I purchased at 100, but in the market it is showing around 96. So I was done already. So I will die. 96 means I have to sell in the future. Means what will happen in the future? Strike price is 96 means I will lock myself as 96. Okay, I will lock myself at 96. Now listen carefully to the point. 96 rupees I have to lock myself. So I locked myself at 96 with a fear that if it fall further, I will die. So therefore I will enter into the market. I locked myself at 96. By God's grace, okay, price went to 108. Price went to how much, sir? 108. If the price goes to 108 on the expiry date, what I will do? I will lapse and I will sell at 108. And I will sell at 108. If the market price fall down from the risk of fall, I will be protected to sell at 96. Okay, like that I will hedge my transaction. So this is a speculative table. Hedge table we have to understand in a different way altogether. Okay, that discussion I will separately make once again. Hope you understood what I said. Speculator is just a person who will pay premium on the due date. If it is favorable, he will buy or sell. If it is unfavorable, he will lapse and bear the loss of premium. That's all. Okay, hedger already have a position in the cash market today. Already, he may either buy the share today, he may either sell the share. If he buy the share today, risk is the fall in the prices when he goes to sell. Okay, therefore he will take a put option. If he sell the share today, short sell, the risk is when you go to the market, the buying price may rise. Therefore, he will protect against him for the risk of loss in the rise in the prices of share. Therefore, he will enter into a call option. Like that, the transactions will change. More about this we will also see in the next problems to come. I think everyone understood how to analyze a small problem like this. Problem is just 1 minute it will take. But there is a 30-40 minutes discussion on the same. You can understand how the options chapter will be. Okay. How good you are in understanding the mechanism of options. So that way you can proceed towards understanding the remaining questions as well. Okay. Question number 5. Consider the following information. Future spot prices we are expecting between 50 to 90 with an interval of 5. 50, 55, 60, 65, 70, 75, 80, 85 and 90. Strike price is 70. Consider a premium of rupees 5. Find out the payoff, means a net profit, to the holder of a call option and draw a diagram. Find out the payoff for the writer of a call option and draw a diagram. So diagram part, keep it away. We will discuss later. First, let us see the payoff for the holder of a call and the writer of a call. Call holder, call writer, payoff. Okay. Very important question only. Good information we can gather out of it. So first, what are the expected future prices? 50, 60, 70, 80, like that, 50, 55, 60, 65, 70, 75, 80, 85, 90. Interval of 5. So strike price is trading at 70. Premium is rupees 5. So let us see the payoff for the holder at different prices given in the question. Okay. See here. So payoff to a call option holder. So let us take question number 5. Payoff to the call option holder. I hope that everyone has copied this. Sir, if you want, you can clearly write here. Payoff for a put holder. Payoff to a call option holder. So SP, we have taken it a slab of 50, 55, 60, 65, 70, 75, 80, 85, 90. Okay. Speculator, let us observe this. Call holder. One point I will explain like a speculator, remaining you can understand yourself. See here. How a speculator react actually? He don't have any cash market position. Directly only F&O segment. He paid a premium today. How much premium he paid? 5 rupee premium he paid. He is expecting that price of this particular stock will definitely go beyond the strike price. Strike price is trading at how much? 70. Okay. He understood that on the expiration date, if the share price raises means I am expecting 79. If it is 75 or 80 or 85 or 90, what will happen? I can buy at a guaranteed price of 70 and I can sell at a higher price, make a sure gain by exercising it. Okay, believing that he will exercise, he will enter into a option market. Okay, but to his surprise, market has a fall in the first 4 cases. Means price in the market is only 50. Means how can you understand this? I have paid a premium of 5 and locked myself at 70. But the price actually trading on the day is 50. Means what will happen? You paid 5 rupee and on the date you waited, price instead of having 70, 75, it came to 50. Means how to understand this? You will buy at 70 and you have to sell at 50. Already you have a loss of 5 rupee in the premium. So you have a great loss if you do this. Therefore, shut your mouth, come out. 5 rupees loss will go. Unnecessarily don't do overaction by buying it. Okay. So therefore, lapse. First 4 cases lapse. 5th case, either you exercise or lapse, same answer. I told you the reason also yesterday. That in the previous class. Whenever there is a gain, okay, so you can sell at 75 by buying at 70, exercise 5 rupee profit. But premium 5, you are ended up with a 0 gain net. 70, 80, exercise 10 rupee minus 5 plus 5. Okay, if the price is at 85, will exercise, value is 15, I paid a premium of 5, net gain is 10. So like that you have to do. Okay, from this what you have to understand, if my loss is there, call holder, if there is a loss to a call holder, loss is restricted to the amount of premium. Loss is restricted to the amount of premium. Loss is restricted to the limited to the extent of premium. Gain can be unlimited. If the price here is 100, gain will be 20. Price here is 130, gain here will be 60. So it go on increasing till the actual price can move. Hope you can understand. So the call holder's payoff is negative if the option lapses. Therefore, maximum loss of a holder is limited to premium, whereas maximum profit is unlimited. So summary position, theoretical notes. Particulars, if you are a call holder, profit is unlimited, loss is limited to the premium. Understood the point or not, everyone in the class? So this is a payoff to a call option holder. It's a payoff to the call option holder. Hope everyone understood. Now let us understand the most important position. What is the position of a call writer? Position of a call writer we have to understand. Call writer has no separate position. If call holder lapses, premium will become his gain. If call holder exercise, whatever the profit he make will become his loss. Because from the call writer point of view, observe this case. How a call holder will understand this? I will buy at 70, sell at 85. Sell at 85. Okay. So, how these situations will really work on the day? Who is a call writer? Call writer has to sell a share. Call writer has to sell a share. Okay. On the date, it is 70 and 85. On the date, it is how much? 70 and 85. I will go to the call writer. I will tell I want to exercise the option. I will buy. So he has to buy in the market at 85 and sell to you at 70. Immediately you will buy at 70 and again you will sell in the market at 85. You are making an obvious gain. He is making an obvious loss. Okay. For you plus 10 is a net gain. For him plus 10 is a net loss. Same thing. So therefore call writer don't have a separate positions. Call writer position will be your gain, will be his loss. His loss is your gain. Technically try to understand. Call writers profit is limited to premium. Okay, call writer's profit is limited to premium, because if the profit of the call writer is going beyond the premium, you will lapse the option. Say for example, take this situation, 70-50 case. Take the first case. Tell me, you are locking yourself at what price? 70. You are locking yourself at 70. If you are a call holder, what you will do? You will see 70, market la 50. Okay, what you will do? If I buy it at 70 and sell it 50, I am having a loss of 20. Really, you will make a loss. You will exercise the option. You will buy at 70 and sell in the market at 50. You will not. Means, if you are about to make a loss, beyond premium, you will lapse the option. You will what, sir? Lapse the option. So therefore, the question of exercise will not come. So writer's profit will be only premium. Writer's loss will be unlimited. Holder's profit is unlimited. Loss is limited to premium. This is the point of difference that you need to understand. That itself is the next part. Writer. See the columns what I have drafted. Strike price, actual price, action by call order, value to call holder. That means first to 4 columns the same. Value to call writer. Call holder lapsed it. Value to call order is 0. Call writer value is also 0. In first 4 cases, same. Therefore, premium is a gain for me. So that will be the net gain. Okay. If you exercise or lapse, I have a net gain even in the 5th case. From here, reverse case. Call holder exercised the option. Means what will happen? He will buy at 70. I have to buy at 75. Writer has to buy at 75 and sell him at 70. Means I am making an obvious loss as a holder. Loss as a writer or not? Holder is making a 5 rupee gain. I am making a 5 rupee loss, but I collected a 5 rupee premium. Net gain is 0 for me. Okay. Next, if it is 90, writer has to sell him. Okay, only at 70 by purchasing at 90. Holder is making a gain of 20. I will make a loss of 20. I made a profit in premium of 5 and making a net loss of 15. So whatever these gains for me will become losses. Okay. From the above, it is clear that call writer has no separate payoff schedule. Based on the action of a call holder, call writer's position will be understood. However, profit of a call writer is limited to the extent of premium, whereas a loss to a call writer will be unlimited. So this is a summary position. Overall profit or loss situation. Okay. So I have written one theory part here. Overall profit or loss position of holder and writer. Particulars, profit and loss. Call holder profit unlimited. Call holder loss is limited to call premium. Put holder profit is unlimited. Loss is limited to put premium. Call writer profit is limited to call premium. Call writer loss is unlimited. Put writer profit is limited to put premium. Put writer loss will be unlimited. Okay. You can copy down. So hope you have completed writing. So this is the end of problem number 5. So we now completed question number 4 and question number 5. So payoff concept I think everyone understood. But one very important point is all the questions we are doing only as a speculator point of view, not as a hedger. So hedging with arbitrage we will see from problem number 13. From here all the questions whatever we do will be done from the hedger point of view, not as a speculator. We will see a different ball game in itself. Okay, when we are doing that problem we will have a different way of understanding the questions. So we have now completed question number 4 and 5. So 6, 7, 8, 9 will be one set we will do. After that variety concept will start called as a break-even concept in options. Once that is also completed, we go into the next area after the break-even called as valuation and arbitrage. Okay. So let's understand the concept clearly and let us do the problems in this regard. So hope everyone understood problem number 4 and problem number 5 with its correct intention. Okay, as a speculator what I will do, I will just pay premium on that day. If it is favorable I will exercise and buy or sell in case of call and put. If it is not favorable to me, lapse and lose the premium, that's all. But hedger, anyway he has to buy or sell, whether to buy in the market or whether to buy with the writer depends on whatever the prices they are getting traded. Clear everyone? Let's go to problem number 6.